pass now to our panel. I'm introduce Richard Romerly, co-founder of Square Mile, and let him introduce his panel on Is the Fund Fit for Purpose? Richard.
No pressure. Thank you, Heather.
Thank you.
Good afternoon, ladies and gentlemen. I'm going to invite the panel up. We might need some more chairs. Should we do? I'll grab one. Okay, thank you. So first one, Michael Ohanessian. Michael, are you around? Michael is the managing director of Praemium. He's come all the way from Australia to join us today. Thank you, Michael. Next to Michael, we have Verona Kenny. She's come all the way from Australia, but she's been here for a bit.
Just a little while.
David Tiller, who's head of UK propositions at Standard Life Aberdeen. And lastly, Howie Lee, who's head of ETFs at LGIM. And we're going to, okay, perfect. And our fifth panelist is you, ladies and gentlemen. These things work much better if you ask the questions that you want to ask, because you can bet your bottom dollar the person next to you wants to ask the same question, but is too scared. So please wade in when you want to. There's lots of people from asset management out there too. This is pertinent to you, so we'd appreciate your views and your questions. And we're here to discuss, is the fund fit for purpose? So, and then the full title, and then we can get into it. Competitive structures to the traditional mutual fund are merging from ETFs to baskets of securities that could be held on platforms. In this discussion, we will look at the future of the fund, whether fees are transparent enough, and if funds will win out in the future or in the long term. So let's start, David. I'm going to ask you a question first. Traditional mutual funds, and then V, you can tackle this after. How much of the business that you do on behalf of the market is in traditional mutual funds?
I would reckon we're still in excess of 95% of platform assets. We are seeing more ETF, but direct equity investment is still very small. It's beginning to get more traction, particularly discretionary managers beginning to play that into portfolios, perhaps for the UK components, whereas they're using funds for overseas components, or even passives and ETFs. So we are seeing it creep up, but at the moment we're still dominated by funds.
So over 95%. V, is that the same experience at 7am?
Not really. We're probably around 75%, and that can change depending on what our large firms are doing. We work with a lot of discretionary managers and a lot of advisory firms that are running models, and if they decide to put into ETFs, we see a swing to that and the other way as well. So it can really depend.
Okay. Howie, yep. ETFs not making much of an impact.
This is a setup.
I was being serious. Why not?
So I think first and foremost, it's interesting. So I've been through this journey for the last 10 years, and ETFs were always seen as, well, is this something completely different? It just so happens that it is a mutual fund. It happens to be listed. So it is really an extension of the traditional mutual fund industry. I think the popularity of it has come from the fact that most strategies are in the passive market cap index end. But we're starting to see that shift quite a bit. If you asked me 6-7 years ago when we started speaking to our clients, and our clients being asset allocators, they didn't touch ETFs, or it wasn't part of the investment consideration. But now, very clearly, most of them look at ETFs or mutual funds interchangeably. So it's really just a delivery vehicle for the investment strategy. And I think where the traction is going to be is what investment strategies are going to be packaged in an ETF, or to be honest, whatever vehicle of the future that technology takes us to.
Okay, and being parochial for a minute in the UK market, I mean, what percentage of the assets in the UK market are in ETFs at the moment?
I believe it depends on where you look at the stats, but it's roughly less than 20% still, right, of the overall European asset management industry. It's been growing, rather than kind of taking market share from the traditional mutual fund space, is as kind of open-ended investments or pooled investments have expanded, ETFs has just captured a portion of that. But I think the expectation, though, is that it will change over time, mainly just because technology and the re-platforming that we've talked about earlier is going to encourage the use of ETFs. There are still some platforms that, for example, can't process ETFs.
Okay, David.
Can I just add to that? I think price has been a big factor in the UK. So passive funds in the UK are very, very cheap. I mean, I think ours start about 7 bips on the platform. And people are still more comfortable with the fund structure. And at 7 bips difference, that's seen as an acceptable frictional cost. I think in other markets, such as the US, there's tax advantages to ETFs, which don't exist over here. So I think that there's different environments. I agree, however, with your point is actually the packaging isn't the thing, it's what's inside it. And I think over time people will get more comfortable with ETFs.
I agree with that, but the counterside to that is that we run a series of model portfolios on a particular platform, not yours. There's a charge for...
Yes.
Yeah. There's a charge for trading ETFs. And what we were asked from a particular advisory firm is, oh, we really like your model portfolios, but could you take those ETFs out and can you put a tracker in or something similar, because we don't want our clients to have that additional charge.
Okay, I'm going to bring Michael in now just for a different perspective because you're in a different market, although you're over here too. Australia, probably a more mature market?
Well, it's about 10 years older. So
what's the experience there, and is there anything we can draw from that, do you think?
Yeah, I'm going to go with Bernoulli because you mentioned fund flows. If that's okay. And really, nature's all about trying to find low energy states, so that's my Bernoulli reference. Water flows downhill.
Very good, well done.
Our platform in Australia really is a thing called an SMA, which I've only just found out is a brand of baby milk or something.
Yeah, it is, yeah.
And the Aussies in the room will sort of sympathise with me because in the United States, that's what happened many, many years ago. We went from wrap platforms and funds to SMA. What is SMA? It really started with this idea that, rather than just buy the fund, let's say it's an equity fund, I can actually just own the assets inside. I can own the direct equities. And that's a trend that happened in the United States many, many years ago. And we're now seeing it in Australia. In Australia, it was a bit stillborn with the global financial crisis, but right now, that's the thing that people want. Why? Because, let's face it, the lowest energy state thing you can do is put it into a fund. Funds are very efficient, lots of operating leverage, but they're not a great experience and they can be very expensive. And the lowest energy state for an advisor is to put an investor into a multi-asset fund. Right? There's nothing easier than that. But with technology now, with this SMA capability, we can actually deliver something that's lower cost, same strategy, same fund manager, and a better experience for our clients. And that's what's happening in Australia now. We're catching up to the Americans now.
Okay, and just to illustrate that, and then there's a question we're going to come to up here. We talked about where we are broadly in the UK at the moment, 75, 95% in traditional funds. ETFs starting to chip away, passive funds, open-ended funds done really well. What's the split in Australia?
So
between SMAs and between your baby milk and everything else?
Yeah, so basically we talk about the wrap market and it's the same here. So it's the same idea, mostly funds and some ETFs, some direct equities, but mostly funds. That's about 850 billion Australian dollars. What we call the managed account segment of the market, where most of the model portfolios don't have a lot of funds in them. They have direct equities where they can and then funds for the other asset classes. That's about 60, 70 billion. But it's grown from about 2 or 3 billion 5 or 6 years ago. So it is the fastest growing segment in the platform market. And we can sort of look to the United States and say, that's what happened there. And the fund managers all had to kind of change their behaviour because now distribution wasn't just having your fund on a platform. You actually had to run the actual equity model, if you like, on the platform. And most of the multi-asset strategies now in Australia, and I'm including firms like BT and so on that you guys know, they're not just offering model portfolios of funds and fund selection, they're actually running actual multi-asset strategies where particularly the Australian equity component is all direct equities and funds become the specialist stuff for property, fixed interest and so on. And so this is what's taking off in Australia. No one's buying DFM, if you like, model portfolios anymore. It's all moving down to this more direct experience.